All right, so today we're doing a deep dive into a corporate move that's way more complex than your typical M&A press release. We're looking at a huge foundational pivot for a company you definitely know, but maybe not in this context, Michelin.
Exactly. This is a classic case of a company using really targeted acquisitions to force a transformation. The main event is Michelin agreeing to buy Tex-Tech Industries from Arlington Capital Partners.
But there's a major catch here, isn't there? It's not a simple buyout.
Not at all. It's almost like a cleanup job.
Yeah.
At the same time, they're helping spin off another company, FMI Industries, into its own independent entity.
Okay, so let's unpack that, because the structure itself tells a story. This isn't just about buying revenue. They're buying a very specific high-tech business and then helping the seller wall off the most regulated, pure-play defense assets.
That's it in a nutshell.
So our mission today is clear. We need to assess the full impact of this deal, dig into the specialized science Michelin is betting on, and figure out how this complicated move fits into their long-term vision. Yeah. Their vision to become, something much bigger than just a tire maker.
Let's start with the immediate numbers. This deal is a massive accelerator for Michelin's push into high-tech materials. You combine this Tex-Tech acquisition with another one, the Cooley Group, and the impact is a huge revenue boost for their polymer composite solutions business.
How big of a boost are we talking about here?
We're talking about an approximate 20% growth in revenue for that single segment, which in dollar terms is about a $280 million injection.
And the deal itself seems financially sound. They're not overextending themselves.
No, it's expected to close in the first half of 2026, after all the usual regulatory hurdles. And crucially, it's going to be fully financed in cash.
That's a key point. They're using their existing liquidity, not issuing new debt or anything. That keeps their balance sheet strong and gives them flexibility.
Right. And to put that in context for you, Michelin's trading around $33 a share, market cap near $23 billion. Their PE ratio is sitting at 13, which is, it's typical for a traditional cyclical auto parts supplier.
And that's the entire point of this acquisition, isn't it? To change that number.
It is. They've got a good dividend, almost 5%, and a good financial health rating, but, revenue's been down a bit, but 3.6% over the last year. This deal is explicitly designed to inject high-margin, non-cyclical revenue to justify a much higher valuation. They're trying to earn a re-rating from the market.
That push for a re-rating is the key to understanding all of this. You have to go back to the strategy they launched, the Michelin in Motion plan from 2021. This was a bold declaration. It wasn't just about optimizing. It was about fundamentally changing what the company is.
They said it themselves. They wanted to go from being just a tire company to being a true high-tech company. Mm-hmm. And a world leader in what they called life-changing composites and experiences.
And that wasn't just, some PR fluff. They put hard numbers on it.
They did. The 2030 goal is to grow non-tire activities to be more than 20% of total revenue. That's a huge shift. And they're executing. They already hit their 2023 financial targets.
Which were pretty ambitious.
Very. Segment operating income came in at 3.6 billion euros, which is above target, and their return on capital employed, or ROCE, hit 11.4%. And for anyone listening, ROCE is a critical number. It tells you how well they're turning their capital into profit. So 11.4% shows real discipline.
And a lot of that capital has been going into M&A.
€1 billion, in fact, between 2021 and 2023. And that money wasn't scattered around. It was laser focused on two areas, polymer composites and connected solutions. It's their insurance policy against the swings of the auto industry.
So with that strategy in mind, Tex-Tech is obviously a perfect fit. Let's look at the asset they're actually buying. Tex-Tech has been around since 1904. What makes them so valuable to Michelin right now?
They're specialists. They make engineered materials for environments where failure is not an option. So aerospace, defense, specialty industrial. We're not talking about simple fabrics. We're talking about materials engineered for protection and precision. And it shows in their growth, double-digit top-line growth for the last 4 years.
Which brings us back to the complexity of the deal, that FMI spinoff. It's like the seller, Arlington Capital, was willing to sell the cake, but wanted to keep a very specific, very valuable jewel that was baked inside.
That's a great way to put it. Fundamentally, Arlington is holding on to the part of the business that's deeply tied to classified long-cycle defense and space programs. This new company, FMI Industries, is made up of two parts, Fiber Materials, Inc., and the Engineered Composites division from SGL Carbon.
So FMI is the pure play rocket science division. What kind of materials are we talking about?
We're talking about materials for the most extreme environments imaginable. Reinforced composites. Think high temperature stuff like carbon-carbon and ceramic matrix composites. These are things that can survive temperatures where any normal metal would just vaporize.
Can you give us a tangible example? Where would you find these materials?
NASA programs. They were on the Stardust mission on the Mars 2020 rover. They're also used in critical missile platforms. When a spacecraft re-enters the atmosphere, the heat is just unbelievable. These composites are ablative. They're designed to burn away in a controlled manner to dissipate that heat and protect what's inside.
So Arlington keeps the super secret regulated space stuff, and Michelin gets the broader but still very advanced specialty textile business.
Exactly. The split clarifies Michelin's strategy. They're buying scalable, high margin, but less regulated material science that they can use across a bunch of different sectors. Tex-Tech's expertise includes thermal protection for space vehicles, burn-resistant materials for aircraft fuselages, fire-blocking textiles for airline seats.
So they're taking what they know best material science and moving it into sectors like healthcare, marine, and construction, where the margins are more stable than tires.
Precisely. And Tex-Tech gives them not just the revenue, but the immediate operational know-how in those markets.
And to show the diversification here, look at the end markets. Beyond aerospace, they're big in protective markets. They make these non-flammable fabrics like a brand called Carbon X, and they have patented tech for ballistic vests.
And that gets us to the certifications. This isn't just a claim. Their products are certified to really stringent defense and law enforcement standards, like NIJ 0101.06. What that means for you is that these products are literally mandated to protect soldiers and first responders. They are mission critical. That creates a huge barrier to entry for competitors.
Okay, so that's the commercial strength. Now let's get into the technical superiority, because this is where the high-tech company claim really gets tested. Let's talk about the science behind these thermal protection systems.
This is the core capability that Michelin is buying, and it's far beyond standard engineering. The research is focused on what they call phenolic impregnated carbon ablators, or PICA. The competitive advantage is all about engineering the material at a microscopic level.
Okay, you got to break that down for us. What's the fundamental science?
At its heart, the science that aligns with Tex-Tech's work is about adding a specific polymer, it's called polyvinyl pyrrolidone, or PVP, into the standard resin mix. But it's not just mixing it in. It's a chemical engineering process designed to create perfectly tailored, ultra-tiny pores in the material.
Why do you care about the size of a pore?
Because size dictates function. They've engineered these pores to be in a very specific range, between 0.1 and 10 micrometers. Now think about extreme heat, say 1800 degrees Celsius, the kind of heat you get during atmospheric re-entry. At that temperature, heat transfer isn't really about conduction, like touching a hot stove. It's dominated by thermal radiation.
So it's like standing right next to a giant furnace.
Exactly. And this engineered microstructure with all these tiny pores acts as a radiation shield. Think of it like a microscopic honeycomb or thousands of tiny mirrors that forces that intense heat energy to scatter and deflect instead of burning straight through.
That's an amazing analogy. They're basically using geometry to defeat physics.
And the numbers back it up. This engineered structure was found to reduce char depth, which is the standard way you measure thermal damage, by up to 42% in laser testing compared to the standard materials.
42%, that's a number that sticks with you.
It's a massive improvement in performance. And that is the ultimate tangible validation point for their whole high-tech company strategy. They are buying world-class proven material science.
And you can draw a straight line from that 42% reduction to their financial targets.
Yeah.
This deal validates their updated 2026 goals.
It does. They're targeting segment operating income of 4.2 billion euros and a segment operating margin of 14%. They can only get there by leveraging synergies and high margins from acquisitions like Tex-Tech in that polymer composites division.
And that's why the reporting structure change is so important for investors, right? They're making polymer composites its own dedicated reporting segment from 2026.
It's all about visibility. By separating out the high-growth, high-margin, non-cyclical business from the core tire business, investors can see the transformation in black and white. It isolates the growth and proves the thesis. If that segment performs, it gives the market the undeniable evidence it needs to re-rate the entire stock.
So what are the key dates to watch?
Well, the next results are coming up. First half results on July 24th. But the real insight into how this integration is going will come in 2026 when that segment starts reporting on its own.
All right, now we get to our This Is Not Financial Advice segment. This is purely for discussion and entertainment, where we pitch an outrageous but plausible trade idea based on what we've just analyzed.
And this trade really centers on that perception gap we just talked about. As we said, the market still largely sees Michelin as a cyclical tire stock, and that's why it has that modest PE ratio of 13. We're betting that the market is wrong about Michelin's future.
So how do you structure a trade to bet on that transformation?
The idea is pretty straightforward. You short a basket of pure play, lower margin industrial textile manufacturers, the ones that don't have Michelin scale or R&D budget. And at the same time, you go long Michelin.
A pairs trade. Why is this plausible beyond that incredible 42% metric?
The plausibility is based on the trend. First, you have the consistent, smart M&A Tex-Tech Cooley group, and you combine that with their proven internal R&D. They're actively de-risking the profit part of their strategy. They're buying margin, and they're buying science.
And the second part of the thesis is the reporting change.
Exactly. That new polymer composite solutions segment becomes a separately reported unit in 2026. If they successfully integrate these high-margin, non-cyclical aerospace and defense products, they should see their margins accelerate fast towards that 14% target. And if they hit that, the market has no choice but to stop thinking of them as just an auto parts supplier.
Because a material science company should trade at a much higher multiple, closer to a specialty chemical or an aerospace supplier.
Precisely. If the market starts valuing Michelin as a high-tech engineering firm, its PE multiple should expand significantly. This Tex-Tech deal, securing certified defense market access and that proven high-temp material capability, is the final piece of tangible proof the market needs to justify that re-rating.
So it's a high-conviction bet that they can complete the journey from the highway to the high frontier, so to speak.
The transition is already well underway.
Okay, so to recap this deep dive, Michelin is using a cash-funded acquisition to strategically pivot into high-performance, complex, engineered materials. They get a critical 20% revenue boost for their polymer composite solutions segment, and they manage a complex spin-off to get exactly the assets they wanted.
And the key takeaway for you to think about is this. The core strength of Michelin isn't just rubber anymore, it's deep expertise in materials engineering. The kind of expertise that lets them build composites for ballistic vests and heat shields that NASA uses to land rovers on Mars. This is actively redefining what a mobility company even is in the 21st century.
And if they can engineer a materials microstructure to cut thermal damage by 42% at 1800 degrees, it really makes you wonder, how long until that science finds its way into high-performance EV battery casings or next-generation construction materials? That's the real potential here. We'd encourage you to keep your own eye on Michelin's Polymer Composite Solutions division as those 2026 targets get closer.